Hello everyone and welcome back to my video. Today I am going to talk about the monetary policy. Let's first discuss about the meaning and definition of monetary policy. In simple terms, monetary policy is a type of macroeconomic policy which is practiced by the monetary authority, that is central bank of a nation, concerned with the management of the money supply in the economy. साधारण भाषामा भन्ने हो भने मोनेटरी पोलिसी वा मौद्रिक नीति भनेको यस्तो प्रकारको नीति हो जसले एउटा देशको अर्थतन्त्रलाई सन्तुलित पार्न मद्दत पुर्याउँछ। इन द कन्टेक्स्ट अफ नेपाल, एनआरपी नेपाल राष्ट्र बैंक, that is the monetary authority of Nepal, exercise the policy to control and manage the money supply in the economy. Types of monetary policy. Monetary policy can be classified into two types, and they are expansionary or ease or cheaper monetary policy, and the next one is contractionary or tight or dearer monetary policy. Let's first discuss about the expansionary monetary policy. It is an action taken by the monetary authority, that is the central bank, to increase the money supply in the economy. To increase the money supply in the economy, the central bank can purchase treasury bills and bonds in the open market, decrease the bank rate or discount rate, and reduce the required reserve ratio. Now let's see the second type of monetary policy, that is contractionary monetary policy. It is the opposite of expansionary monetary policy. It is an action taken by the monetary authority, that is the central bank, to decrease the money supply in the economy. To decrease the money supply in the economy, the central bank can sell treasury bills and bonds in the open market, increase the bank rate or discount rate, and increase the required reserve ratio. Now let's see the objectives of monetary policy. Price stability. Price stability means the absence of greater fluctuation in the general price level. Economists generally regard a 2 to 4% annual increase in the general price level as a stable price level. Inflation and deflation represent a cumulative rise and fall in the general price level. In the case of an inflationary situation, contractionary or tight monetary policy is required to reduce the price level. On the contrary, in the case of a deflationary situation, expansionary monetary policy is needed to increase the price level. Price stability वा मूल्य स्थिरता भनेको मूल्य स्तरमा ठुलो उतार चढाव नहुनु हो, तर इन्फ्लेसन र डिफ्लेसनले गर्दाखेरि सामान्य मूल्य स्तरमा ठुलो उतार चढाव आउँछ। इन्फ्लेसन भएको अवस्थामा मूल्य स्तर घटाउनका लागि कन्ट्राक्सनरी वा टाइट मोनेटरी पोलिसीको आवश्यकता पर्दछ भने त्यसको विपरीत डिफ्लेसनको अवस्थामा मूल्य स्थिर बढाउनका लागि एक्सपान्सनरी मौद्रिक नीतिको आवश्यकता पर्दछ। Full employment. The most important objective of the monetary policy is to achieve full employment. Thus, to achieve full employment in the economy, expansionary monetary policy can be used, which increases the money supply and reduces the rate of interest. Lower interest rates and increased money supply help stimulate economic activity, which leads to higher demand for labor, thereby reducing unemployment and moving toward full employment. देशमा रोजगारी बढाउनको लागि सेन्ट्रल ब्याङ्कले इकोनोमीमा मनी सप्लाई बढाउँछ र इन्ट्रेस्ट रेट घटाउँछ, जसले गर्दा इन्भेस्टमेन्ट र स्पेन्डिङ बढ्छ र नयाँ रोजगारीको अवसरहरू सिर्जना हुन्छ, जसले गर्दा इकोनोमीमा लेबर डिमान्ड बढ्छ। When the central bank increases the money supply and reduces the rate of interest, businesses are more likely to take up loans to scale their businesses, and consumer borrowing power also increases, leading to a rise in aggregate demand for goods and services. As businesses expand due to higher demand and increased investment, they hire more workers. Increasing employment leads to a rise in income and consumption, which results in a boost in economic activities and drives the economic growth of a nation. जब केन्द्रीय ब्याङ्कले इकोनोमीमा मनी सप्लाई बढाउँछ र ब्याज दर घटाउँछ, व्यवसायहरूले आफ्नो व्यवसाय बढाउन ऋण लिने मात्रा नि बढ्छ भने कन्ज्युमरको खर्च गर्ने क्षमता पनि बढ्छ, जसले गर्दा वस्तु र सेवाहरूको माग पनि बढ्छ। उच्च माग र बढ्दो लगानीको कारण व्यवसायहरू विस्तार हुँदै जाँदा रोजगारी पनि बढ्छ र इन्कम र कन्जम्सन पनि बढ्छ, जसले आर्थिक गतिविधि र राष्ट्रको आर्थिक वृद्धिमा टेवा पुर्याउँदछ।
Reduces economic inequality. Monetary policy helps to reduce economic inequality by providing income generating opportunities and access to the financial services to the poor and marginalized people, and also by offering loans at lower rate. Balance in external payment and stable exchange rate. Monetary policy helps maintain balance in external payments and ensures exchange rate stability by controlling inflation, managing interest rates, and increasing capital flows. By raising interest rates, the central bank can reduce inflation, which helps preserve the value of the national currency and reduce import costs. Higher interest rates also attract foreign investment, increasing foreign exchange reserve and supporting the local currency. Additionally, tighter monetary policy can reduce excessive demand for imports, improving the trade balance. Altogether, these effects help stabilize the exchange rate and maintain a balanced external payment position. Instruments of monetary policy. The instruments of monetary policy are the tools used by a central bank to control the money supply, interest rates, and credit in the economy. They are generally divided into two types, and they are quantitative or general or indirect instruments of monetary policy. And the next one is selective or qualitative or direct instruments of monetary policy. Let's first talk about the quantitative instruments of monetary policy. Quantitative instruments of monetary policy are tools used by the central bank to control and regulate the overall money supply and credit in the economy. The quantitative instruments' primary aim is to control inflation, manage employment levels, and stabilize the currency. The quantitative instruments of monetary policy are bank rate. The bank rate is the interest rate at which commercial banks borrow funds from the central bank using government securities and other approved securities as collateral. When the bank rate is high, borrowing from the central bank becomes expensive for commercial banks. Conversely, when the bank rate is low, borrowing is more affordable. Therefore, the bank rate plays a crucial role in controlling the money supply. The another instruments of quantitative monetary policy is open market operations. Open market operations refer to the buying and selling of government securities by the central bank in the open market. When the central bank sells securities, it withdraws liquidity from the market, leading to a contraction in the money supply. Conversely, when the central bank buys securities, it injects liquidity into the market, resulting in an expansion of the money supply in the economy. Through these open market operations, the central bank effectively controls the money supply in the economy. Cash reserve ratio. The cash reserve ratio, or CRR, is the percentage of a bank's total deposits that must be held in reserve at the central bank. When the cash reserve ratio is increased, banks have less money available to lend, which reduces the money supply in the economy. Conversely, if the cash reserve ratio is decreased, banks have more reserve money available for lending, which expands the money supply in the economy. The another instrument of quantitative monetary policy is statutory liquidity ratio. The statutory liquidity ratio or SLR is the percentage of deposits that banks are required to maintain in the form of liquid asset such as gold and approved securities. When the SLR is set higher, banks can lend less money, which reduces the overall money supply in the economy. Conversely, a lower statutory liquidity ratio increases the lending capacity of banks, thus expanding the money supply in the economy. Now let's talk about the qualitative or selective or indirect instruments of monetary policy. The qualitative instruments of monetary policy are tools that central banks use to regulate the allocation of credit within the economy rather than the overall amount of credit which is managed through qualitative tools. These instruments aim to direct credit to specific sectors or restrict it from others. The qualitative instruments of monetary policy are margin requirement. The margin requirement refers to the difference between the value of collateral and the amount of loan issued by a commercial bank. For example, if the central bank sets the margin requirement at 40%, a customer can borrow up to 60% of the collateral's value from the commercial bank. Increasing the margin requirement reduces the availability of credit while decreasing it increases credit availability. Therefore, the central bank can influence the availability of bank credit by adjusting the margin requirement. The other qualitative instruments of monetary policy are moral suasion. Moral suasion means advising, requesting, and persuading the commercial bank to cooperate with the central bank in implementing its general monetary policy. And the next one is direct action. The central bank may penalize or restrict banks that do not comply with its policies. And the next one is credit rationing. The central bank may set limits on loans to certain sectors to control credit distribution, such as may fix the limit of maximum loans and advances to the commercial bank or fix the ceiling for specific categories of loans and advances. Thank you for watching this video till now. We will again meet in our next video, so stay tuned and stay happy.